Hi, I'm Star Mims. I'm Star Realtor, actually a real estate entrepreneur in the business since 2011. And I have my friend and longtime co-partner, if you would, that has been in the loan industry, has been in the real estate industry, and he's just an expert at his craft. I would like to formally introduce my friend and colleague, Al Williams.
Thank you, Star. Appreciate that introduction. And yes, we've known each other for quite some time. And thank you for the humbleness of saying I have some experience. But yes, been around the block for 27 years, be 28 years this June. So I love the experience that I have so I can share. So I'm here as a co-host and a visitor to your show, which you're doing an awesome job out there. Anyone needs to get some real estate done, listing, buying, Star is the person that will go to the end of the moon for you.
I
So, yes,
appreciate
Star, I
that.
can share some loan products with you that can help your audience.
I would love that. I think that in this market, I think that a lot of buyers shy away because they don't think that they have opportunities for themselves. I don't think that they have the full scope of what kind of loan programs are out there. And truthfully, I think that there would be a lot more buyers in the market if they were to explore more unique loan options geared towards their situation. So that's why I really like what you have to offer. So without further ado,
All right, Star, I will go ahead and share my screen here. And do you see that? Lending Al Williams 626. Is that on the screen? Okay.
lending loan products, Team Al Williams.
All right. I just want to make sure I got the right technology going on the right screen. I have three screens here in my home office. So I will get started here. My name, of course, Al Williams. I've been in the business, as we said, 27 years. My NMLS is there at the bottom, 27 14 20, BRE 0146 1081. I started as actually a telemarketer in the loan business up to 2009 and got my real estate license in 2009. I met Star in 2013. We were doing REOs, and now we're in the 2023 market. I say it's the Michael Jordan market. So we're going to go get championships. That's Michael Jordan, one of my favorite players, wears 23. So we have to make 23 a little better than just hearing about inflation and rate hikes and what's going on in the market, because there are some exciting things that are actually taking place. So first off, I do A through Z as far as lending. So we will go through those vehicles. We will touch on them rather quickly so we don't keep you here and bore you. But we are also can be accessed after you see this recording. I am right now working 6, 7 days a week due to the market. And here's one of the products that we do offer. I empowered Team Al by Lending 3, a line of credit for seniors over 62. I feel that it lost a little traction because interest rates went up and the loan limits got decreased. What this means is basically someone that is over 62, and it only has to be one borrower over 62, that can access equity in their home. And this is important in this type of market when the major banks have risen the FICO requirement to 720 to 780 to get a ELOC, which is a line of credit. That line of credit is also dictated by your debt to income ratio, so how much income you have coming in, and it's also dictated by the credit score. On a reverse mortgage, we have a line of credit that will allow you to eliminate FICO score and debt to income ratio and access the actual equity in your home to live out the fourth quarter of your life and have some resources. Neat thing about the line of credit, it does have a growth rate. Growth rate now has increased to about 8%. They were 6%. That means the untapped portion in your line of credit will grow, and you do not have to access the entire line. So some of the requirements that you need to know, one borrower needs to be 62. You do have to pass a financial assessment test. You do have to take in the full application with your income and run that financial assessment test. You do have to do a third-party counseling. You do have to have your house up to FHA standards. It is an FHA product, which is insured by FHA. The reverse mortgage, as I said, and I want it to be bold, is that your credit score is not going to determine your qualifications. So if you have fair or not too good credit, you still can qualify for this program. They're going to make sure that your taxes and insurance are covered, meaning that it's called a LISA set aside. So it's a life expectancy set aside, putting your tax and insurance aside for you. So let's give an example, Star. Let's say we have a young individual at 75 years of age. Life expectancy is based on 81 for a male, 84 for a female. They're going to put those taxes and insurance aside for 10 years, 13 years, just to make sure that the tax and insurance are paid. And unlike times in 2013, when there was a lot of foreclosures because of the borrower not being able to pay their taxes or forgot to pay their taxes and they went delinquent. The no debt to income ratio. So on a forward mortgage, and reverse mortgage world gave that tag to the forward mortgage. It is a conventional loan, an FHA loan, any type of loan that you have to repay as far as a monthly debt on a promissory note. On a reverse mortgage, you have the options of no payments. You can make payments, but you have an option of no payments. Unlike a forward mortgage, you have to have certain debt to income ratio. Basically, in layman's term, what's going out the door, which is your gross income, versus, what's going out versus your liens, installment loans, revolving credit versus what's coming in, your gross income. We don't have to do that. It's the financial assessment test is key. So what I did, Star, is I gave you a big laundry list of what I have all in my head, and I can share with your audience today. We are licensed in 16 states with 17 state coming up. We do have a free grant program called the Dream House. This is a free grant, Star, for your buyers. It is an FHA product. You could have owned a home before. As long as you don't have an FHA loan, your client's Star could qualify for the Dream House. This is a nice loan because it is not repayable, the grant. The grant is free. Can't say enough, free. Unlike other grant programs, you have to pay them back. The neat thing about the Dream House, Star, is your clients can access this program and not be eliminated from the qualifications because of income limits. Other grants do have income limits by county, by how many people are going to live in the household. The Dream House does not have income limits. So we can qualify someone with low income, medium income, and high income. This free grant program right now is 2% of the entire 3.5% of the down payment. We hope to see that the market is starting to correct itself. Interest rates are starting to be stable, that we can get this grant back up to 3.5. We do have a 2-1 buy down program, Star. We just added, and it's not on the screen, but I do have a slide for it later. It's a 3-1 buy down. So for your audience that are listening right now in layman's terms, I want to talk pure vanilla. It's starting the interest rate below the note rate. So what is prime? Prime is a rate that we have that's dictated by the feds. The banks sometimes put layovers on these rates. Right now, we're hovering about 6%, 6.125 Star. That means that that client can start 2% below. So that can help you show them a home and give them a direct need. Right now, your home buyers are coming to you saying, is it a good time to buy? I think it's always a good time to buy real estate. But one thing that I coach on is need. What is the need? And then affordability. The need obviously is the house, the bells and the whistles, the barbecue, the swimming pool. We're going to share Christmas there. But the need is also the tax write-off, the appreciation, the stability of the home, and the investment. But the 2 or the 3-1 buy down allows them to start at a lower rate, 3.84% for 12 months. And then that second year, they go up 1%. And that third year, they lock in. If they're on a 3-1 buy down, then they have actually 3 years of a lower interest rate. So the CalHFA program, we do these. This is a grant, Star, that's going to be 3.5% down payment, but the qualification is a little tighter. We do need a 660 FICO score, and the debt to income ratio is a little lower than our dream house. Give an example. CalHFA is saying that the back end ratio cannot exceed 44.9, and the dream house is 55%. In my experience, I have found as I run applications on a daily, monthly, it is hard to get sometimes that individual or that couple under 44%. They're running roughly around 47, 48. And then, yes, we do have the ones that streak out all the way up to 53, 54, 55. So the Dream House is a program that allows the back end ratio of 55%. This is really key if some of these programs are going over your head, is that star, all she needs to point you in the right direction is just 3 bits of information. Your gross income for the last 2 years, your desired area that you want to buy, and she can kind of tell me and custom tailor to what your max payment that you think you can afford, and then let us put it all together for you so you can get your maximum purchase power. The last step to that would be what kind of assistance do you need. So we do have 3.5% programs as low as 580 star. This is for purchase and refi. We do have a 10% down for those low FICO scores. So let's say we do have individuals that are running in the low FICO score, they can still purchase, but they're just going to need a bigger down payment. We have what's called a bank statement program for those self-employed people. You do not have to bring your tax returns, nor do you have to bring W-2s. You're going to bring 6 to 12 months complete bank statements. We're going to take those deposits and we're going to configure that as your gross income. So there's some matrix to it. Personal bank statements versus business bank statements. On business, we have to have a business expenses. On personals, we do not. For those that are refinancing, are purchasing over 80%, we do have lender paid MI program. The next one under that is a DA, which is zero down payment. If you're a veteran out there, first of all, I would like to say I appreciate you. Thanks for your service. I am a stepson of a veteran, and I was forced to learn real estate when I was 10 years old. And that veteran came back from Vietnam, bought him a duplex in LA, and turned that duplex into about 5 different pieces of real estate. So as a kid between 10, 18, and up to young adult at 24, I actually learned what appreciation was, how important to save your down payment and use leverage. At 18, I was traveling 30 miles one way to maintenance a 2-unit in Los Angeles, LA. So collecting rent, knowing what rent versus ownership was embedded in me at a young age. So the DSCR, this is a good program start for your investors out there. So when you're out there and you're meeting investors that want to add to their portfolio, number 1 star, remember in your audience, it's no limit on how many homes you can own on the DSR. So it's unlimited. And the debt service that covers the rent, that covers the mortgage payment is the qualification. Let the home be the qualification, not the individual. The individual, yes, has to have some decent credit, 580, 620. They want to start mostly over 600. They have to show a 12-month history elsewhere. A 12-month history elsewhere. So if you're an investor and you're an investor, you do have other properties, you do make mortgage payments, so you can easily put a 12-month history together for us. And then we find that property, Star finds this property for you where the rents are covering the debt. You qualify. You qualify with a 15 to 20% down payment. We already talked about the reverse mortgage products. We do have a conventional 5%. Star, a lot of people have forgotten about the USDA loans for your rural areas, horse properties, for your guys that are out there in construction. You need to park your big rig. Norco area, you got some areas in the Riverside area where Star is located. This USD loan works almost in a 3% to 0% down payment. So we would have to customer tailor that to you. For those people that are here and you are working and you have an I-10 number, we do have purchase products for you on I-10s. We went over non-QM. We just launched a private money, hard money. I like to call it private money. That loan got the word hard because people felt that the interest rates were high, so it was a hard loan to pay. And they started calling it hard money back in the 70s and 80s. This is the private money coming from private institutions that are being really creative with a 3, 5, 10-year term amortized over 30 years. So it's not like you have to pay this money back in 6 months. There are terms that'll give you 3 to 5 years. You can use this for purchasing non-owner occupied property, for investment property. Star, I just bailed out a gentleman that inherited his mother's property in Los Angeles, duplex, during COVID. Tenants weren't paying rent. He fell behind. Before you know it, ballooned to $36,000. We got him some COVID money, and we got him a private $75,000 second to do home improvement, get this home rented. He was on the verge of foreclosure, and every person that entered his world was saying, just sell it or sign the deed over to me. I sat down with him, coached him for about 2 weeks. We got the paperwork together. He's back on track. The loan is reinstated with SPS. So we had to do a little loss mitigation work, communicate. We communicated with the bank on mostly almost a daily to give them an update for like 40 days because it was on the verge of foreclosure. They want to know, when's the money coming? We've heard it before. So we actually got them a private loan to bring it current, and now he's back on track. The neat thing about the private loan, Star, is that we were able to put away reserves in escrow for 8 months to pay the 12-month note that he's on. Because the plan is after 12 months of current payment, he's going to come out and refinance and get rid of that private entity. So here we go. Next to last is our ARM loans. The 3, 5, 7, and 10 represents the years. I say to a new homeowner, you don't have to look 30 years down the road. You can look at a 5 to 10, 7-year plan. And that plan starts you off with a lower interest rate with an ARM. And it's some education that we would start backwards with you on how that ARM works and how it's going to adjust and when it adjusts. But just for you listeners here, if you picked a 3 or 5 year, that means it's fixed for 3 to 5 years. And the bank's going to allow you to start off at a lower interest rate than prime. So if a 30-year fix is 6.5 today, you might be able to pull off a 5.25 ARM, have a lower payment. And if you were savvy enough, you could also look at interest-only options. These are not for your school teacher and the local mechanic, but I definitely would show this to some entrepreneurs, business people that are trying to get into the real estate market with a lower payment. And then talking about lower payment, last, we do have 40-year terms that match up with a lot of our programs. And then the next slide is just to close us out on the hard money. The hard money, Star, this goes into your listing arena. If you have any people in your audience that are looking to list their property and sell, but they don't have money to fix up the bathroom, the kitchen, we do have a pre-listing rehab loan. As long as Star has this under contract and we run the numbers, we're able to front them the rehab money. So Star can give them projections on selling the house for top dollar, more dollars, which is more net in the consumer's pocket. And so these loans, we do go up to 200,000, but typically they're running about 30 to 40,000. Star, you're used to rehab, so you know when you walk in the house what it's going to cost to spruce this house to compete with the comparable down the street where they just did the fix and flip and it sold top dollar, which is the consumer looking at. Why is that house selling for 700 and you're telling me I'm only going to get 6? Well, that's where this pre-listing rehab listing loan comes in to inject a capital infusion to your sellers. It is going to be a note. It'll go on title. There's a promise to pay when they're in escrow and close, to come in with the crew. I have a crew. Star has a crew. Come in and rehab that kitchen, bring it up to par. If there's some repairs that we need, a new AC unit, things in that nature. So we do have commercial opportunities. I do go to all my brothers and sisters out there and young folks that are leasing their businesses to look to buy. And they have decent commercial SBA loans out there. Obviously, we do fix and flip for investors. 20% down payments are the no-brainers. And what's hot right now, Star, is the ELOCs. ELOCs are hot because there's a percentage of Americans that have an interest rate under 5%. There's another percentage that has a rate under 4%. And there's a huge percent of Americans that have under 3%. And they need to tap into equity because of inflation and rate hikes. For example, the rate hikes didn't just raise interest rates for mortgages, it raised interest rates for car loans, credit cards, student loans, installment loans, revolving debt. Sat with a client the other day and average credit card debt was 29.9%. 6 cards. On an ELOC, you're below 11% on an ELOC, and you can get this loan done in about 2 weeks. No appraisal done. It is a full documentation loan, so we do need to show 2 years worth of income. And last is the piggyback seconds. This helps also in the buying power if you needed to bridge a loan or get a second to help you with a down payment on a property. So I would definitely get to the last slide, which is what I showed in the beginning, was the 2-1 buy down, which is one of the hottest purchase loans right now. This is a Excel spreadsheet here on what we do to punch the numbers in. On this example, as I did just today on someone interested in buying some units, and purchase price here is 800,000. So that should be 1.9, but get it right. The loan amount is 1.1 million, and over here in the circle just shows the credit we need from the seller, and over here is showing the interest rate at 4, 5, and 6%. This is kind of a high-end Star, but this was on a 4-unit property where the homeowner investor is going to receive about $8,500 in rent. So with the current rent, they're going to be able to pay in those first three years this lower payment right here. So this is your note payment, the $7,084, and then over here is your buy down. So if you look at that buy down of $5,585, $5,585, look how much lower it is than the $7,784. So this gives them time to look at the current market and what the current market's going to be in. So I will stop sharing my screen, and the last I would share with Star's audience. Once again, thanks for having me here. Try to keep it as quick as possible. Star is in the position right now to negotiate seller credit. Seller credit can be between 3 and 6% on a property. On an investment property, it's 2%. What this means is that she's going to the sellers or she's going to the market to find and identify properties that have been sitting. There's properties that's been sitting for over 60 to 100 to 150 days. There's still a reason why that seller needs to sell. They need a buyer. This is an opportunity for buyers to get a bargain, a deal, or a negotiation. That's why they call it a buyer's market. 18 months ago, we weren't at a buyer's market. 18 months ago, we were in a seller's market. There, when Star showed up to the house to show it, there were 30 other people there. Now, when you go to see the property, it's less competition. And she will go more in detail on how she can custom tailor that to your needs, which is you do need an experienced person that can navigate through that. So I appreciate the time and the platform, Star. And if anyone has any questions in the future, just go ahead and text me and we can do a 3-way Zoom, or we can do a face-to-face.
Thank you so much. I think that this is great for the community overall, the community of buyers. I get so excited because, like I said, this negativity in the atmosphere, and correct me if I'm wrong, isn't 6% still a good interest rate? I mean, it might be, it is, right? I mean, your experience, you've been in the business. I mean, I think that, hey, it's not a bad interest rate. Maybe people
Well,
don't.
like I said, Like I said, sorry to cut you off.
No, you're fine.
It's affordability,
Uh-huh.
and we have to match
Yeah.
affordability up with the programs that we went over. It's the need. The need. I would hate to see someone wasting $2,800,
Yeah.
$3,200 in rent and paying 100% versus paying 6% and having a $35,000, $40,000 tax write-off. And
Exactly. And
if
then
you look at history, we didn't go below 5% until 2000. So interest rates as a mortgage never went under 5% until the year of 2000. So if
right.
you look at when they started tracking interest rates on mortgages back in the 1930s, our interest rate never went under 5% until 2000. And there was reasons why it went that way, but then we got spoiled and it stayed that way for years, 12 years to be exact.
Yeah.
And then it went lower. So then when the rate hike went up, obviously COVID had a play in this and inflation. So it was a rapid raise. The Feds are meeting tomorrow. And so the hint is that they're going to do a quarter point versus a half. So that's a good thing because they were on that half point, 3/4 points for the last 12 months, which saw our interest rates double, 3 to
Mhm.
4% hike.
Mhm.
So right now, in the last 4 months, we've had a reprieve of the lowest rates in the last 5 months. So right now, if you track the 10-year treasury, which is how our interest rates are dictated, the 10-year treasury had creeped up over 4%. And now it's roughly come down to where we need it to be about 3.5. So you're definitely correct, Star. Definitely correct. It's not a bad rate.
Well, I thank you for that. And thank you so much for your time. As Al said, you can call him, text him, you can hit him up on DM. He's on social media. And I'm so happy to be able to call you my friend. And thank you so much.
Thank you so much, Star, and the best of luck and blessings to you.
Thank you, you too.
All
Bye.
right.